Hello, welcome to AleaSoft webinar. My name is Alejandro Delgado. I'm associate partner of AleaSoft, and thank you for joining us today to the webinar with the topic Prospect for the Energy Markets in Europe, Storage, Self-Consumption, and Services for Retailers. As usual, our speaker today will be Oriol Saltó, associate partner of AleaSoft, that will analyze the evolution of the European energy markets and hot topics like energy storage, batteries and green hydrogen, self-consumption, and the services that AleaSoft offers to retailers. If you have any questions at any time during the webinar, please use the Q&A menu and we will answer them after the presentation. And now, I hope you enjoyed the webinar. Go ahead, Oriol.
Thank you, Alejandro. Good morning, everybody. We are back after the summer break, so we didn't have a webinar in August. I hope all you enjoyed the summer. Well, if you are in the southern hemisphere, that's not your case, but also I hope you are doing well. So as Alejandro mentioned, we are going to do the usual review of the evolution of the energy markets. And in this case, in the second part, we don't have invited the speakers, so probably we will talk a little bit about energy storage and self-consumption, following what we said and what we showed in our last webinar in July, and we will also show you what are our services more specifically for retail companies, and hopefully we'll have some time at the end to answer some of the questions or to enter again some of the, if you have any special interest in something on what we said or in anything about in general about the energy markets in general. So first, a few words about AleaSoft in case you don't know us. In AleaSoft, we provide forecasting services and analysis of energy markets. We cover all the energy markets in Europe, also some markets in the Middle East, some in South America, some in North America, and we have data for a lot of markets all around the world. So we are ready and have the data available to provide forecasting services for basically energy markets at the global level. The methodology that we use for forecasting is our own methodology that we developed ourselves specifically for forecasting in the energy sector. It's the three main points that we always like to stress about this methodology is that it is a completely scientifically based methodology. It's a hybrid model that combines some of more classical statistical techniques like regression, econometrics, time series analysis, etc., combined all together with artificial intelligence methods like recurrent neural networks, machine learning algorithms. So basically combining several models in order to get the most powerful techniques of each of the individual components. This scientific based of our methodology gives us consistent forecasts that keep the coherency from one delivered to the other. The coherency of our forecast is something, it's one of the aspects that our clients appreciate the most. We have been in a relation with our clients, some of them for more than 25 years. And the third point is exactly this one. This is the methodology that we have been using for 25 years. This year, we are celebrating our 25th anniversary of the company. And it's the it's the methodology that has brought us up to the present. We divide our services in under 6 divisions. We have a division for everything related to the long-term price forecasting up to 3 decades ahead. Another division for all the short-term up to the mid-term forecast. This means demand, renewable energy forecast, price forecasting, everything up to the day ahead or hours ahead, up to 3 or 4 years ahead. We have a PPA marketplace and a marketplace for buying and selling renewable projects or renewable assets. we have a division where we offer all the services related to storage or hybridization of storage and renewable energies. We do revenue forecasting for battery projects, for instance. We have a division devoted to information, so we regularly publish reports about the evolution of the energy markets. We are doing these webinars monthly about explaining how the energy markets are evolving and basically treating all the interesting topics about the energy sector. And we also make all kinds of reports about any aspect related to the energy sectors, being from guarantees of origin, law reports, reports for due diligence, everything that is needed for the energy sector. And then Alea Consulting based for and basically for any kind of strategic consulting in order to have some information and in order to make responsible decisions. With all these services, we basically cover all the needs of all the players in the energy sector, from grid operators to producers, to consumers, to traders, investments, funds, basically any player in the energy sector at some point will need one of our services. Okay, and as always, let's start with the fuels. We always start with the evolution of the Brent oil price. The oil price is more or less an index on how the global economy is going. Right now, we have a global economy that is based on fuel and fossil fuels. So basically, oil price is kind of this global index about the global energy. So if you remember in our last webinar, it was mid-July, or at the beginning, the second week of July it was. We were basically at this point around $95 per barrel, and we were saying, okay, we are already in the summer. Summer is usually a high demand season for oil, so basically we were seeing that most of the risk was upside. We were seeing an upside risk, and even some of the analysts were saying that it wouldn't be strange to have prices during the summer up to the $90 per barrel. Well, the reality has been completely the opposite. Prices have been going down since then, and really down, even at some points below $70 per barrel. Basically, this expected rise in the demand that, as we will see afterwards, there was really an increase in the demand during the summer. But basically, what prevailed over that was the pessimistic view on the demand at the long term, or at the mid and the long term. So basically, China, that is one of the the key players when we are talking about oil demand. The expectation of growth are really not being met. So then this pessimistic view is what it's putting downwards pressure in prices, and that's what we saw during the last 2 months. And right now, in the short term, as the geopolitical tensions in the Middle East are increasing, also we have had just yesterday a cut in the rates by the U.S. Federal Reserve, so disincentivize a little bit the oil consumption. So basically, in the short term, we are expecting prices to go up. Already today, they are close to $75 per barrel. So basically, in the short term, prices are going to go up. Also, OPEC plus the some of the main producers at the global level, basically seeing how the price goes going down, they announced back in June that they were start increasing production in the fourth quarter. So basically, in some weeks, at the beginning of October, they will start increasing productions because they had cut productions in place. But seeing how the prices were going down, they just delayed this start of the increase of the production. Although they keep the expected increase in 2025, but in the short term they delayed starting this increase in production because obviously that would additional downwards pressure on the prices. And okay, as as we mentioned during the summer, the oil demand increased, and that was something that we expected to put enough upwards pressure in the prices. So basically, this is the surplus deficit ratio. And during the third quarter, we see how, as expected, the market was really tight. So where supply and demand was quite balanced, even falling on the side of demand. But as mentioned, this didn't put enough pressure in the prices. For the remainder of the last quarter of the year, again, we are expecting a surplus of supply in the market. So really not from the supply and demand point of view, there will not be too much upwards pressure in the prices. And as we mentioned, China is one of the main players when we are talking about oil demand, and the expectation is that the imports of oil in China for the second part of 2024 are going to be basically the same as last year, but during the first half of 2024 they were slightly below. So basically in the global of the year, imports are going to decrease. So again, this is what is sending this message, this pessimistic message about the oil demand growth at the long term. If we look now at the gas prices, these are the TTF gas prices, and in July in our last webinar we were in the middle of an upward trend. During the summer, this upward trend continued. Basically, here we have again several things that are trying to be in balance, and again one of them is winning. So on the side of lowering prices, basically demand is slightly increasing, but is still very low. So from the demand side, we are not seeing upwards pressure on the prices. Also, as we will see afterwards, the reserves are beyond 90% full, ahead of the goal of having 90% by the 1st of November. So basically, we have full of reserve to face the winter. The demand is really not very high, so this would mean downwards pressure. But again, if you remember, from the last month, we have been saying that the gas market is very fragile. So basically, any news, any bad news or something that could bring some kind of disruption of the gas supply, it's basically increasing the prices, and this is what we have been seeing. One of the key events were in the Ukraine and Russia war, when Ukraine started invading Russian territory. They started invading it in the Kursk region, where there is one of the last stations that is pumping gas from Russia to Europe through Ukraine. So basically, although the gas that we are receiving by pipeline from Russia is just now 5% of the total supply of gas to Europe, although it's a more fraction. I mean, as I said, the market is very nervous. So just this news about the war that could bring some disruption to this small fraction of the gas supply also push the price upwards, just realizing that this is not a very stable market, and we are seeing a lot of volatility. We already know what happened in 2022. So basically, the contract for this remaining supply from Russia is ending in 2025. There are basically 0% probabilities of this contract being extended beyond 2025. So basically, all this is putting some uneasiness into the market. So basically, as the demand increases, as we are approaching the winter, as this uncertainty about this remaining supply from Russia is still uncertain, probably we will be seeing volatility for some months. So no really good news about the gas. The good news about the gas is that we are filling our supplies at the same rate that we were doing last year. So right now we are 93%. The goal was to have 90% by November the 1st. So we are already beyond that goal, and we are more than 1 month ahead of time. So at least from the supply during the winter, it should go really, really wrong in order to have supply problems during the winter, because we have relatively stable supply of LNG. We have plenty of reserves. So basically, from the risk of supply side, it shouldn't be any problems facing the winter. And on the CO2, it's been relatively boring. Basically, prices have been oscillating between 70 and 60 euros per ton. Basically, no changes. Again, this market is making no clear trend, no clear trend in the short term. At the long term, we expect increasing prices, but in the short term, there is no clear trend. There is some volatility in prices, basically due to some speculative movements, and also because this price is highly correlated with gas prices. So basically, if we have volatility in gas prices, we should also expect volatility in CO2 prices. Okay, let's move now to the electricity markets. And as always, I took this opportunity to show you one of the services that we provide to our client. It's an online database showing and making available all the information that may be needed at some point for any player in the energy markets, being you an analyst, a trader, investor, a journalist, a CEO, anyone. They say that information is power. This is really true in the energy sector. So we have grouped and put together all the really relevant information for the energy sector in one place. It's always updated. It's always ready to be analyzed, ready to be downloaded, always in the same format. So very, very convenient to have all this data ready available. So if we look at the prices for the electricity markets, European electricity markets from the last month, this is the monthly average price. The last whole month that we have is July. We didn't have the opportunity to show. Sorry, it's August. It's August. Now we are in September. So the last full month is August. We didn't have the chance to show July because we didn't have any webinar in August. And so the last full month that we saw in our last webinar was June. So basically since June, most of the prices have been increasing. So during the summer, electricity market prices have been upwards. Italy, since June, Italy was at 25%, Spain and France around 60%. Then and then we have a couple of markets, Germany, UK, that slightly decreased prices from June until now. 4% in minus 4% in Germany, minus 16% in UK. But basically during the summer, more temperature, more demand, so higher prices. Also during the summer, we have less wind, we have less hydropower. That means less renewable, although we have more solar. In general, we have less renewables, so less renewables usually means highest prices. Also, as we have seen, gas prices have been increasing during the summer, so higher gas prices, usually higher electricity market prices. So basically, this has been the trend during the summer. If we make a zoom over the last weeks, this is the daily average price since June until today. Basically, you can see the slightly upwards trend, and basically you can see how France is still the market with the lowest prices, although the Iberian market is getting close in most of in some days lately. But again, France is still the market with the lowest price if we exclude obviously the Nordic countries. Then if we make even a closer zoom to this, those are the hourly prices since the beginning of August. So basically, you can see how we are having from time to time negative prices, some hours usually during the weekends and during the solar hours. And you can see here this on the September the 3rd of September, you see this huge spike, mainly in a lot of countries, but mainly in Germany. Germany had the highest, above 650 euros megawatt hour, and this was just an episode that we can relate with the wind energy. So if we go to the Germany observatory, we group the variables in observatories, usually grouping by country or by type of fuel. We have fuel, fuel prices. We have also macroeconomic data, GDP data of some countries, and then we have futures, monthly futures of electricity, futures, gas futures also. And then we also have forward curves, some of the things that we look usually in our webinars. So as we see, we have a lot of data ready to be explored. You can also have some kinds of analysis. You can change temporality, the granularity of the series. You can have monthly average or yearly sums, depending on the variable. You can also have some filters like moving average. So very interesting. And also you can download the data and then perform your own analysis with your preferred tool. So the episode of high prices that we just saw in Germany mainly, as I said, it's really related with wind energy. So here you see the daily averages. In blue, you see this is the price, and basically you see that the price for September the 3rd was really high, and you can see how this was a really low wind day. These are the onshore and offshore wind, really wind day with very high demand. There are also other days with low wind, but as you can see, they are either weekends or days with less demand. So as you can see, there are a lot of non-linearities. So a little more or a little less wind or demand, depending on which regime you are, can really make really large differences on prices. Let me show you just this is the last one thing. The last thing that I want you to show is the situation on the Iberian market prices, because if you remember, during the spring, those are the hourly prices since the beginning of February. If you remember, during the spring, March, April, we had a lot of hours with zero prices or even negative prices for the first time in the Spanish market. And basically, mainly producers obviously were worried about this situation. And we already saw that in the beginning of June, the situation was recovering. As we explained it in previous webinars, this is a typical situation during the spring. It's the season of the year with the lowest demand, less extreme temperatures, the lowest demand, and we usually had a lot of renewable energy, wind energy. Also, solar energy is starting to increase during the spring. And then this year, on top of that, we had a lot of hydro production. We were coming from 2 years with very low hydro production. This year we had very high hydro production. So everything on top of the previous that lead to this situation. That is something that can occur, as we mentioned. We can see similar situations. We saw similar situations in previous years. We can see those kind of situations during the spring in the following years, but at the long term, we have more storage as we increase the renewable demand because we start decarbonizing sectors like transportation, like the industry, as we start producing green hydrogen. This situation is going to become more rare. Obviously, we will still have days with negative prices in the future, but it's not something recurrent enough to make to jeopardize the profitability of the renewable energy investment and projects at the long term. And as you see, during the summer, during July and August, the situation was really different. We still had some days with very low prices or even negative prices, but it was not a recurrent problem, and it's something that it's not going to be really worrying, at least until the next spring. Okay, so if you are interested in the services of our online database, just go to our website. There you can fill a form, or just write us an email, and we can show you what are the characteristics. We can even let you try it for some days. Okay, let's move now to see the futures market, what the markets are saying right now about the energy that is going to be delivered in the future. And this is the forward curve right now for the Brent oil. We are comparing it with the forward curve that we saw more than 2 months ago in our last webinar in July. So basically, as spot prices for Brent has been decreasing during the summer, it also did the forward curve. So basically 2% decrease in what is remaining of 2024, 10% for 2025, and then at the long term, basically no changes. This is the forward curve for the TTF gas. So again, as the spot prices are increasing, we saw an increase in the forward curve for 2024, also for 2025, much less for 2026. And then for the rest of the curve, we are seeing a decrease. And at this point, it's interesting because we are always trying, or we are following closely what are the changes on the forward curve for the very beginning, and it usually behaves as expected, as the expectations and depending on how the spot prices is moving. Usually 2026, 2027 is a pivot point, so they are pretty stable around these years. But then we see this long-term tail that is moving really with no really following without following any reason about the fundamentals behind the prices. So it's interesting, and I found during this summer, I found an interesting analysis that the International Energy Agency did about why the prices at the very end of the tail of the forward curve are changing so much. Why are they so volatile when they should be more stable than the short term? Because basically things 30, 20, 10 years ahead shouldn't move as fast as the short term is moving. And basically, they analyze that these prices are really much higher than they should be if we just look at the fundamentals, because as we mentioned, we right now are in Europe, at least, in a difficult situation because we are trying to replace our main supplier of gas, that was Russia. So obviously we expect higher prices, and as new LNG supply, mainly at the global level, is going to increase, so we expect prices to go down. Why the prices are increasing at the long term when they shouldn't, at least? So basically, they analyzed and they found that those prices at the long term were really much higher than they should be if we just look at the fundamental. Because as more and more LNG is going to be available, then basically the prices should be lower and more stable. And they found three possible reasons for that increase, or for that volatility and large prices at the long term. One is that the market expect delays in the new LNG projects. Some of the projects have already announced delays, but some of them are ahead of time. So that could be one explanation. The other one is that they expect a really strong increase in the gas demand coming from emerging markets in Asia. That is something that is expected at the long term, because as more countries are switching from fuel and from coal to gas in the first stage of the energy transition before going to renewable energies, we should expect an increase on the demand, but really the prices of the coal should go up and prices of the gas should go down in order to this switch to gas to be produced in Asia. And then that the other reason, that is the one that I find the most likable, is that they are really liquid markets. So they are really not following, there are not much transactions at these maturities. So basically, they are following more the short-term fundamentals than the long-term fundamentals. So basically, they are fluctuating because there is not much activity. So basically, anything can make a really large change. And the CO2 forward curve, basically, as prices have been really oscillating around this 70, 60 euros per ton, the forward curve has been following. We are seeing, compared to our last webinar, nearly 8% down in the whole horizon. And finally, the forward curve for the electricity futures markets, basically in the short term, basically we are seeing the same behavior that we saw in the spot market. So decreasing in Germany, in France, although the spot market increased, the spot market it's quite low compared to the other market, so also went down. And again, this illiquidity of the market at the long term can produce this kind of volatility. 3.3% increase in Italy in just a couple of months for 10 years ahead. It's really a large change that it's difficult to explain based just on the fundamentals or the changes that we expect 10 years ahead. So again, just a reminder, these forward curves are not very appropriate to be used as price forecast. They are just a reference of what are the prices that are being paid now for the energy that is going to be delivered into the future. So it's not exactly the expected price into the future. Okay, and just as a summary of what we have been seeing in this first part, what are the key elements that we are now taking into account when forecasting power prices in power markets? Brent prices, oil prices have been decreasing over the last 2 months, basically due to the pessimistic view on the global growth at the mid and the long term, and increase in geopolitical tensions right now may bring some upwards pressure in the short term. Gas prices are continuing their upwards trend. We expect still some volatility during the winter as the demand increases, as the end of the supply from Russia it's coming to an end. That's uncertainty. Uncertainty brings volatility. And electricity market prices have been increasing during the summer. That's what we expected due to the increase in the demand and reduction of wind and hydro power. And then, as always, in the long term, prices will be driven by renewable energy generation, the production of green hydrogen, how we developed or how we implemented the larger scale energy storage, and how the hybridization is something that we are going to talk about in the second part of the webinar, how the hybridization of all these technologies are going to play a role in the energy markets. Okay, so that brings us to the second part of the webinar. Just let me make a 2-second break. So, following what we said in our last webinar, we talked on how we identified 15 key vectors for the energy transition. You can find a series of 3 news pieces in our webpage. If you just go to our webpage and search for key vectors energy transition, you will find this publication. There are a series of 3 publications where we analyze individually each of these 15 key vectors. And in our last webinar, we were talking about 3, well, there were 4, because there was also green hydrogen. One of the, not the most important, because really all of them are, as we said, key vectors, so all of them are important. But these 3 in this case work very closely. So we usually analyze or show them in all them together, because all of them play a very close role in the energy transition. So we are going to explain and show some interesting numbers. In the case of the energy storage, we are going to be talking particularly about batteries, and then how the batteries and renewable energies work together, how they working together can bring some interesting aspects. For instance, when talking about PPAs, we will talk about that. And then the interaction between renewables and demand, it's using self-consumption. We are also going to give some numbers about self-consumption, basically to see what's the trend. So what can we see and expect about the self-consumption in the following years. So let's just start. How a battery works. Obviously, this is not a detailed explanation of how a battery works, but basically any energy storage system, the main theory behind how we are going to use this is basically to store energy during moments of low price or low demand. We can store energy from our own production plant, or we can store directly from the grid, and then store this energy and release it in moments with high price or with high demand. Basically, and doing that, basically what we get is the price difference. So basically, if we store the energy when the prices are low, we are paying low prices or avoiding to sell the energy at low prices. And if we sell it or inject it in moments of high prices, we are basically gaining that difference. So we can, even without producing energy and without producing any energy, we can still get a price difference. We can do that once a day. We can do it twice a day. Even if we are very active, we can do it several more times during the day, looking for smaller price differences. But basically, the typical alteration is 1-2 cycles per day. Cycles meaning charging and discharging all of the capacity of the of the battery or just a fraction, because it is usually not used at 100%. One of the reasons is to make it a lifetime larger. It's better not to use always 100% of the capacity, so it's usually used 60-80% in order to make it last longer. So basically, this is giving us revenues because we are doing price arbitrage in the wholesale electricity market. But this is not the only revenue that we are going to use. Just using price arbitrage in the daily market, right now it's really not affordable, so it's not profitable to install or to invest in an energy project. But batteries are flexible enough; they are really suitable to provide ancillary services. So basically, fast response services where when the system operator is trying to balance supply and demand in the grid, or having enough reserve in order to respond rapidly to any incident. So this is an additional revenue that we can get from using a battery. And then capacity payment. If the market has a capacity market, then as we are providing some firm capacity at the long term, we can already receive payments for that service. Let's say the service that we are putting power into the system, that it's going to make the system more reliable at the long term. So we can also receive revenues from that side. And with all these components, plus now at the beginning of the deployment of the energy storage, some aids, some subsidies on top of that, right now we are seeing battery energy storage systems profitable or safe investments at the as safe as an investment can be at the long term. And when talking about batteries specifically, they are suitable for several ways of using it, are flexible enough to have them in very different sizes, let's say, or energy storage capacity sizes. We can use it as we have been mentioning, so having it connected to the grid or connected to a power plant, being able to store energy for the grid, from the grid, storing energy from the power plant. This is what we call a utility scale, so a energy system that it's connected directly to the grid. But they are flexible enough to be used even in domestic installations. So it's usually installed in all together with a self-consumption system, where basically we can store the energy that we self-produce and that we don't use at the moment that it's produced, so we can use it later when maybe if it's a solar system during the night when there is no production, we can use a stored energy. So an important fraction of the investment in new energy storage system is going into this residential system, and also from the commercial, from the industrial system installations. I mean, batteries are flexible enough to be used in very different kind of situations. And why we are talking about batteries as the energy storage system that we are going to use? Well, basically because they have been experimenting a very rapid decrease in prices. The technology is evolving very fast, and if we look back to 25 years back, prices have fallen by 97%. That's a lot. And this trend, this is a logarithmic scale plot. So basically, you have $10,000 per kilowatt hour here, and at the very bottom we have just 100. In the middle we have 1,000. So this is a logarithmic scale. So the decrease the decrease is really rapid. But basically, this rate of decreasing, this exponential rate of decreasing, is the same, more or less the same rate that we are seeing right now. From month to month, we are seeing prices of the batteries going down. So we regularly talk to our clients so we can get a feeling on how the price of the investment, what's the capex that they are expecting, and prices are decreasing from one month to the other. We are seeing important decreases in prices. So in the last year, not even a year, in the last 9-10 months, we have seen a decrease in the capex of about 20%. So this rate, that historical rate, is the rate that we are seeing right now. So in the coming years, they are going to be even more affordable. So the investments are going to be safer. And another way to see how the technology is evolving, how the price decreases as we increase the capacity that we install of batteries. So again, this is a double logarithmic graph. So the decrease is still even steeper. So this is how the price decreases as we increase the installed capacity. And historically, every time the capacity doubles, we see a decrease in the price of 20%. And again, this is the rate that we are seeing nowadays. So in the coming years, even in the coming months, we are going to see how batteries are let's say the perfect energy storage system for not for all the situations, but for some of the situations that or some of the problem or inconveniences that the increase in renewable energies are putting in the electricity system right now. So storing, for instance, storing the energy produced during solar hours and shifting it to the night demand peak when there is more needed. So basically, batteries are very suitable right now to be the primary source of energy storage that we are going to develop, and this is what we are seeing. So basically, we are seeing since the last, I would say 12 months, we are seeing an increase on battery projects that we are receiving and the battery projects that we are realizing. So basically, is the hot topic right now, as they were the renewables back in 2019. Now the batteries is the kind of project that is now the one that is increasing faster. And energy storage and batteries in particular is present in all the national energy and climate plans of all the European countries. So all the energy and climate plans talk about energy storage, about batteries, also about green hydrogen, how it's going to be used for energy storage. So it's going to be important in all the European markets, but not all the plants in all the countries give a specific target. So this is something that we miss in some of the energy and climate plans. But we have the case of the Iberian market, so Spain and Portugal, that they give specific numbers, and and we can get an idea on how the energy storage is going to increase. So in the case in both Spain and Portugal, we see how hydro pump energy storage is going to be, let's say, the main of a key component on the energy storage. Right now, Spain has 6 gigawatts, Portugal have 3.6 gigawatts, and in both cases, the pump storage capacity is going to increase. In Spain, we also have concentrated solar power, solar thermoelectric production that also has an energy storage component that it's also expected to increase, although it's we have no new plants right now in progress, and it's a technology that it's a little bit difficult to introduce, but still it's one of the targets of the plan. And then we have batteries. For Portugal, they expect 1 gigawatt of battery by 2030. And in Spain, they are expecting 9 gigawatts of batteries by 2020. And remember this number, 9 gigawatts, because if we look right now on how many projects have requested access and requested connection to the grid, we are seeing quite a different number. So right now we have around 20 megawatts of battery connected to the electricity system in Spain, but already more than 10 gigawatts have already their permits granted. So we can expect most of 10 gigawatts to be ready sometime in the future. And also more than 8 gigawatts pending. They have already requested access and they are pending their approval. So in total, it's more than or near to 19 gigawatts of batteries expecting to be connected into the future. And if you remember, the target for 2030 was 9 gigawatts. So although it's difficult that we will get all the 19 gigawatts in place, it's a number that is pretty above the expected target. So it looks like we are going, at least in Spain, we are going to be in time and in capacity to the expected target. And okay, as I said, the energy storage is something that makes total sense to have it close to the production close to the energy production from the energy that you want to store, because obviously you can charge the energy from the grid, but if you put the battery right next to the production, being it solar, being it wind, you avoid sending this energy to the grid, making the grid less stressed, making having less losses. So basically, directly storing the energy on site instead of sending it to the grid to store it elsewhere makes total sense. And in fact, most of the energy storage projects that we did in 2024 are of hybrid projects. Some of energy storage hybridized with solar energy, some of wind energy, and we even have made some projects of the hybridization of wind, solar, and energy storage. So it's really what makes sense, and what most of the investments are looking now is to install energy storage in an existing power plant, or if you are designing a power plant, already design it with some energy storage in place. And as I mentioned, most of the projects that we have done in 2024, we do revenue forecasting projects. Most of them are of hybrid projects, and it's really what really makes sense if you start thinking about it. And as I told you, as I said, hybridizations have some really interesting implications for PPAs. So PPAs right now, most of them, the ones that are signed right now, most of them are pay as produced. So this is very good for producers because they basically has very low risk, but it's less optimal for the off-takers, because all the risk is on the off-taker. So basically, if you move the risk from the producer to the off-taker, basically the prices go down. If you put some energy storage capacity, or if you hybridize two technologies, solar and wind, for instance, then you are able to provide more stable profiles. You are able to provide something closer to the baseload that is usually the optimal for the off-taker. So basically, if you are able to provide a more fixed profile, then you are putting less risk on the off-taker. So basically, you can get higher prices. So from the point of view of a PPA, hybridizing your renewable energy with energy storage or with other technologies makes a lot of sense. And it has implications like having better conditions, basically having higher prices. And just as a reminder, in Alea Hub, we have a PPA marketplace where we can find the best project for you, even if you are a producer, or even if you are an off-taker. And just as the last numbers I'm going to give you about self-consumption. As we said, at the residential level, energy storage in batteries makes a lot of sense when you put them all together with self-consumption, basically, usually solar panels. So these are the numbers of installed capacity in the last years in Spain and in Portugal. In Spain, we are above 7 gigawatts of installed capacity, and we are talking of more than 3% of the total demand already being produced with self-consumption. In Portugal, obviously numbers are lower because we are talking about a smaller country, but around 350 megawatts of installed capacity, more than 1% of the total demand of the country. Although the numbers are different, the trends are in both cases of clearly increase, exponential increase, basically because we are at the beginning. It's going to be difficult to keep this rate at the long term, but the trend is clearly of going up. And we are, well, basically self-consumption puts less stress on the energy grid. It decentralizes not only the consumption, but also the production. So it's a key component also of the energy transition, the decarbonization of all the economy. And just to finalize, what are the services that we have for retail companies? Specific services for retail companies are electricity demand or gas demand forecasting for your clients or for your portfolio of clients. We have we can provide it as a services or as an application where you input your historical data of consumption of demand from your clients or your type of clients, and then you get a forecast, being it at the short term or being it at the long term. And then as a retail company, as a company that works in the energy sector and that places offers in the markets, you can also use our general services of prices forecasting, not the day ahead market, but also intraday system imbalances or price stochasticity if you are managing risk. At the long term price forecasting, guarantees of origin, very interesting for retail companies. Futures forecasting, if you are again hedging in the futures market. Very interesting. Also, the online energy database that I have just shown you, a PPA marketplace. If you want to find a project to sign a PPA and provide green energy for your clients, and then any strategic consulting that you need, being it anything about the energy market that is relevant for your company. And just to finish this image that we usually show to show how our long-term models work, how the market equilibrium works, how this forecast that we made back in 2010 is still showing what is the equilibrium price at what the futures market are really setting the price right now. So obviously with prices fluctuating, but also always fluctuating around the market equilibrium price that we forecasted back in 2010. And just to finish, let me invite you already to our next webinar. It's going to be the October editions, webinar 48, and it's our annual appointment with Deloitte. Again, in October, we are going to have Deloitte as invited speakers. We are going to talk about financing, about asset valuation, and obviously anything that you want to ask. So that's it. Thank you, Alejandro.
Thank you very much, Uriol. Really great presentation. As usual, when you have the time, you can expand on the topics, and these are really interesting topics. Thank you for that. And we will start now the the Q&A section of the webinar. Since we have a couple of minutes left, we can answer some of the questions that you already have posted. So I will answer one. Do you have best outlook for Europe? I understand Spain provides the most reliable data, but would be good to have some intel for that as well. And yes, we have most of the projects that we have received are for Spain, but we have other projects in other continents as well, analyzing best, both in standalone setup or with hybrid with solar, photovoltaic, and wind. So yes, we cover other European markets. We have experience in other markets as well. Some markets are more advanced on this topic than others, but we are covering most of Europe on this regard. Uriol, I see you mark some.
Yeah, sure. A couple of questions. How is the battery storage in Spain developing within the next years? So basically, looking at the numbers that I've shown you, how much capacity is being requested, and looking at how the electricity market is working. So basically, how much we need it in order to the market to work properly, and based on how much projects are we being asked in the recent month, we are expecting batteries to start increasing by next year at the latest. So maybe at the beginning of 2024, but 2025 is going to be for sure one of it's going to be the year of when the batteries energy storage projects start appearing physically, not just in paper, in Spain. And we have time for the last one. The number of self-consumption in Spain and Portugal are for the residential buildings of PV plus storage or only PV? Well, they are from different sources, and they are not. So for Spain, they are for photovoltaic self-consumption. In the case of Portugal, it's all the self-consumption. So most of it is photovoltaics, but there is also probably some wind self-consumption. But basically, the idea was to show you the scale, so the size of how much demand they are covering, and the trend, how it is increasing, and how we expect it to keep increasing in the future.
Okay, perfect. So that concludes the webinar today. And as Uriel mentioned, I invite you all to register to our next webinar in October. We will be sharing it again. This, I believe, is for the 5th time with speakers from Deloitte, and it's always one of the highlights of the year for us. So thank you again, Uriol, for the presentation, and the audience for joining, and have a nice day.
Goodbye.